Okay, this is Rhonda Thomas, and we're just about to do financial accounting in the classroom for Chapter 11's coursework out on Cengage. We're talking bonds. We're going to do a bond with a discount and a bond with a premium. Okay, bond is a debt instrument. This is our second liability chapter. Our first liability chapter was Chapter 10. Okay, so when you first get to a bond problem, if you will go ahead and write down everything you have been told about a particular bond, and I always put it in a rectangle. And the reason I do is everything on that bond is a contract. So it will stay the same no matter what. There's no changes to something on a bond unless there's a contract provision that says it will change. Okay, so anyway, the reason corporations sell bonds is to borrow money without creating ownership. Okay, and it has to be paid back, and the interest has to be paid. So the first thing I want you to do in this problem is I want you to put down the face of the bond, the face value. And how you find that is it's always going to, this is when they start describing the face of the bond. Issued a $43,400,000 5-year 8% bond at a market rate of interest of 10%. So, wow, there's a lot of information right there. By the way, this is July 1. It's always good to know what the date is that you're doing this on. Okay. Then it talks about receiving cash. This is the price of the bond. Okay, that's the price of the bond. If you are talking about a bond discount, that means that that price is going to be lower than its face. And sure enough, that's exactly what's going on here. The reason is our bond has an 8% rate, or whatever yours says, the market rate, also known as the effective rate out in the market, which is affected by the economy, right? Fluctuations in the economy is actually higher than our bond. So for whatever reasons, the market rate has gone up, and our bond is not as attractive as it once was as far as to investors. So to entice investors to buy our bond, we have to offer it at a discount, kind of like a sale, right? We're getting ready to have Black Friday. By the way, just real quick, I don't want any financial accounting students not understand what the word black means. It is not race. It is not color of any kind. All it means is being in the black is you're operating at a profit. Being in the red means you're operating at a loss. And there was a time that, and still today, the retail stores out there, this is their push season, right? And they're really trying to push the sales so that they end in the black for the year. So just in case you didn't know that, no, it's nothing wrong. You might win a trivia game or something because you knew that. And AC/DC has a song called Back in Black. That's what it means. Back in the money, right? Back in the profit. So it's not such a dark thing like you might think it is. All right, I'm going to put down my face. All right, so I'm putting down 43,400,000. So I want you to put down what your face is on your bond. I want you to put down what the contract rate is. Mine is 8%. I'm looking at a time frame of 5 years. Now that's when the bond has to be paid back. When you know your time, when you know your maturity date, look and see what it says about when it's paying interest. This one says interest on the bonds pays semi-annually. That's the most popular way for bond interest to be paid, is twice a year. So if something's going to be paid twice a year, then we want to take 5 years times 2, and we're actually going to make 10 payments of interest, or there will be 10 payments of interest to the bondholders over this period of 5 years. So that's an important piece to understand. So I'm going to put 5 years times 2 is 10 payments. Okay, so that's good to know. Now we're going to calculate the interest payment. Are you ready? How do you calculate an interest payment? It's always the loan principal, right? And by the way, that's basically our loan principal. That's the face. It's the face times the contract rate times the interest period. Okay, so I'm going to put 43,400,000 times 0.08 times 1/2. The reason it's times 1/2 is because we are sending that out twice a year. Okay, so put your face in. 43,400,000. Okay, let me put my commas in. My brain doesn't like to read numbers without commas. So times 1/2. So I want you to calculate. Mine is a pretty big interest rate. Okay, mine is a pretty big interest rate. So I'm looking at, a $43,400,000 bond is a lot of money. Okay, 43,400,000 times 8% times 1/2. Okay, I just put that in there in my Excel spreadsheet. Okay, and I'm going to hit enter. And let's see what we get. I got $173,600. Now I'm going to test it one more time. Okay, I have gotten things wrong enough times in my life that I know that I need to do things at least twice.
You took the 8.
Now, if yours is 8%, what does your contract rate say?
10.
Okay.
10 or 11.
Okay. There are 2 rates on this bond problem, and you have to be careful. So here's where you're at, Monty. This is your face in the bond problem. Here is how long the bond is supposed to last. There's your contract rate. So whatever says that is the contract rate. You always use, and that's why I put all of this in a rectangle, because it's on the bond. Okay, everything up here is on the bond and it will not change. Okay, the market rate, which I put down here outside of the rectangle, is the market. Okay, the market rate. This market rate is affected by what? The economy, right? So its rate can fluctuate. Our bond rate never fluctuates. It stays the same. Okay, so you always want to make sure you put all that stuff down. Oh, see, that's not the right amount. Yep, I think I left out a 0. Yep, I did. So see, I'm glad I did this twice. And if measuring something twice is good enough for carpenters, it's good enough for us. Okay, so all right, so I've got to fix this. So I have one, I left out a 0. Yeah, there you go. Okay, so if you want, we can run a couple of if you want, how much did you get for your interest payment? First of all, what's the face of your bond?
It's 43
million.
$100.
Okay, so mine is 43,400,000. What's yours? 347. Okay, so very similar numbers, right? So whatever you get should be something close to this. 8%. What do you have, Haley? What's your contract rate? 11. What's your contract rate? And it's right here. in your problem.
10.
Yours is 10?
Yeah.
Okay, so Haley's is 11, yours is 10, mine is 8. My market rate is 11, or I'm sorry, is 10. So what's your market rate? It's probably higher. Well, because we're all doing a bond with a discount. So we're all having the same thing. So what is your market rate of interest?
11.
Okay, and your contract rate was what? 10. Okay, so everybody's market rate should be larger. Okay, it should be. That's what we expect. Because that's how a bond sells at a discount. Now, I went ahead and put my bond price here. I need to change that. I can also put the bond price down here. So the bond price is how much you're receiving in cash for that bond. Okay, so I want you to write that down somewhere. All right, so I'm going to put in what mine is. Okay, mine is 40 million. $48,617. That is my bond price. And you can always see that when we're offering a bond at a discount, it's going to be less than its face, right? Is it less than its face? Yes. Okay, and we're going to get ready to do a journal entry, but I want you to understand these characteristics about the bond, because if you don't, you can really start to have issues, and there's really no reason to have issues. Just understand what we're doing here, right? Okay, so we're offering at a discount. Now, how much is that discount? Here's what I want you to calculate. I want you to take your face, the face of your bond, and subtract the bond price. Okay, subtract that bond price. So you actually know how much the discount is. You say, golly, that's a lot of work and we haven't even gotten started yet. Well, first things first. Okay, so I want you to know, what is that discount? What's the difference between the face and the bond price? Well, mine is $3,351,383. Okay, we'll need to know that when we get ready to put this in a journal entry. Okay, and once again, my market rate is 10%. Because this market rate is higher, there's more investors flocking to other investment opportunities than this bond. So we've got to sell it for less than its face to be attractive. So I wanted you to read this too. As interest expense. Okay, so now we're going to get ready to do the journal entry. Okay, we're going to get ready to do the journal entry. So here we go. You want to draw some T accounts? It would probably be a good idea. Okay, I've got a T account here for a bond payable. You always put the entire face of your bond in the account bonds payable. Okay, so however much is on your bond, you need to put that in your bonds payable. It's going to be a credit to bonds payable, because that is now a liability that we owe back, right? We owe back. And what does this say? Face of bond always. So whatever you put down as your face, that's the amount that goes in bonds payable. And this is happening on July 1st. Okay, there's our first part of our entry. So put that in as your credit. Okay, because you're creating this liability from this point on. Okay, 43,400,000. Put that in. There's a start. Okay, there's a start. Okay, now because we have a discount, remember I had you calculate that discount. Now we're going to use that amount. Where are we putting it? We're putting it in an account called discount on bonds payable, right? A discount always has a debit balance. A premium, which we'll do next, always has a credit balance. So the amount that you put down for your discount needs to go in this account. Okay, so that's gonna be one of your debits. Okay, one of your debits is the discount, and you need to calculate how much that is. So the difference between the face of your bond and your bond price is that discount. Okay, and then you put cash, right? And cash is the bond price that they're telling you the cash you received for it. And when you magically put that in, guess what? You have just created your journal entry for issuing the bond. Remember, issue means to sell. So we've just raised basically $40 million, 48,617 for our business to hopefully grow. Yeah. So that becomes, so now let me go to my cash account and put my bond price in on here. So that is the journal entry that gets things started, right? Gets things started for this bond financial effort we're making here. Is everybody good with now? Yes, you could have started with the cash that you received. That's no problem. If you wanted to look at it that way, you can. You can always start with the cash you receive. You always need to put the face of the bond in the bonds payable, and then the discount, whether it has a discount or whether it has a premium, right? A discount means you received less cash than the face. A premium means you received more. We're going to keep this in here. Okay, and I need to put my discount in, and I need to put the cash amount in. So my discount then is the 3,351,383. All right. So there it is. Okay. Okay. So we did calculate our interest payment, right? So go back up to when you calculated the interest payment. The interest payment was taking the face times the contract rate times 1/2, right? And because we all have about the same bond faces and prices, I would say it's probably $1 million something or other. Mine is $1,736,000. We have to pay that to the bondholder. Okay, that's their interest income twice a year. Woo! All right, so here's how you start to understand how to create the interest payment. Whatever you calculate right here, that's the check that goes out. In fact, I'm going to put next to my amount here, that is the interest check that we mail. Interest check, yes?
You get this
Okay, which one?
on the discount.
Okay, let's pick cash. Cash is the amount that you received for the bond. So if you go up, how much did you receive? So over here, cash received, that's the amount. And so I probably kind of did this backwards. Okay, so let me do the entry for the bond one more time. Okay, to make sure you understand it. So they did give you the bond price. The bond price will be your cash going up, right? Mine is 40,048,617. Then I know that I'm going to put the whole face of my bond in the bonds payable. So then that credit would be 43,400,000. And the difference, Monty, right? The difference is this discount. Okay? When you put this number in, that's the cash, that's the bond price. And you put the face in, the discount is the amount that makes this journal entry balance.
Okay.
When you add these two numbers together, it equals the face. The face goes in bonds payable. Okay, good question. Good question. Okay, so there's quite a bit of stuff to calculate in this, but so that's why I think it's real important to label things and keep it separated out so you know what's going on. Okay, now we're ready to start talking about an interest payment. We've already calculated the amount of interest that that we have to pay to our bondholders. Okay, I've got 1,736,000 going out in interest. And this is actually going to be the interest payment to the bondholder. Okay, interest payment to the bondholder. So we borrowed how much of their money? 40 million of their money and change. But so we're going to send them 1,700,000 basically every 6 months until the 5 years are up, or until something changes that they can do in the contract, but it all has to be agreed upon. So when you know how much interest you're going to pay them, that's the first thing I recommend you put down. So this happened in July. Now it's 6 months later and it's time to make an interest payment. The interest payment is the amount you calculated before we even got started. So we're going to send them a check from cash, and we're going to make cash go down by 1,700,000. I got to go look at it again. 1,736,000. So that is always going to be the interest payment if it's the full 6 months, and it is. The nice thing about this bond is we bought it on July 1st, so we still had 6 months to go before the end of the year. If that gets off, you have to calculate how much, like, is it 5 months of the year? Is it 4 months of the year? That kind of thing. But we're just keeping it simple as much as we can. So we're going to put that in as the cash going down, right? Because we've got to send that check to them for 1,736,000. All right. So then here comes the next piece. This discount that we created, okay, we've got to take the discount, okay, and divide by the number of payments, the interest payments that we're going to make. So put your discount down. Mine is 3,351,383, and I'm going to divide by 10 payments of interest. So over 10 payments of interest, we're going to make this discount amortize. You say, what does amortize mean? We're going to use it. We're going to use this discount over the next 10 payments of interest. And when we're finished, there won't be anything in here. So we're going to make it go down by 1/10. If yours is due in 5, what's your bond period? 6 years. Okay, so yours is going to be 12. What's your bond period? Mature. How many years?
7 years.
7 years. So you're going to divide by 14 payments, right? I just happened to get lucky and get 5 times 2. I know. So what we're going to do is every time we make a payment, I'm going to make this go down by 1/10. So that goes in as a credit. Okay. So yours is a 14th, 1/14. Yours is 1/12.
Well, you get the gas.
The cash is the bond interest payment that we calculated. The bond interest payment.
Is this the bond?
Okay, and there's quite a few things that you've got to kind of keep track of. I know. So when you okay, nope, this is your bond. This is your interest payment up here. You need to label that interest payment. Interest payment. Okay, this is your bond discount. You got a label. Yeah, this is your bond discount because you got quite a few things going on here. And I think this is 2 million, right? So here is your interest payment. That's going to be the cash that gets paid out every time we make a 6-month payment. So you're going to have to make cash go down by that amount you calculated as the interest payment. Okay, right? And then the next piece to find is taking that discount and amortizing it. When you amortize your discount, the discount is the difference between the face and the bond price. You got to divide that by how many payments of interest you're going to make. You're going to make 14. You're making 12. I'm making 10. So I divided my discount by 10. And every time I make an interest payment, I'm going to make this go down. So this is called amortizing the bond discount. The word amortize basically means to expense that discount over those payments, right? Payments of interest. Since we're paying interest twice a year, it's the maturity date of the bond minus 5 years, minus 5 times 2 is 10. So we're going to, this is called straight line amortization. If you remember a little bit about straight line depreciation, we simply took the amount of the asset and divided by its useful life. Okay, so that's why this is called straight line amortization. And once you make a 6-month payment, it's that same entry again, 10 more times, right? So now that you know how much you're going to amortize the discount, mine is $373,865. Then the last piece you find is interest expense. Okay, interest expense. Interest expense is what you call a plug number. If I was to ask you what a plug number is in accounting, what would you say? It's the amount that needs to be plugged in where there is a missing piece that makes this be a balanced transaction. Right? Debits must equal credits. That's been the rule all semester. So if these are your debits and these are your credits, you can tell that this side has a lot more than this side. So we're going to plug interest expense to find its number. Okay, so I'll show you how you do that. To find the interest expense, right? Finding it is the amount that you're sending out in cash and subtract that amount of amortization of the discount. All right. So, and then you check it. I got 1,362,135. Okay. So when you're finished with this transaction, all your debits must equal your credits. And the good news, looks like I may have not calculated something right. Let me try it again. Okay, let me try it again, just a second. So I must have, so my turn to figure out what I've done wrong. All right, so I've got to calculate that differently. All right, here is my discount. I know my discount is right because I got it up here. Okay, and then let me put in, make sure I've got this. Oh, here's what's wrong. This was from the last time I did this. All right, so I'm going to take 3,351,383 and divide by 10. Okay, so 335,000. There we go. 335,138 is my amount of discount that I'm amortizing. Let's try this again now. 335,138. Let's just check it. I think I got it. Nope, It still isn't right. Okay, let me try again. So let me see. It might be a rounding thing. What does it say here? Round to the nearest dollar. Okay. Okay, so I got 335, 3,351,383 divided by 10. And I got 135, 138. I am going to make this into a decimal. Okay. Okay, all right, okay. Well, guess I have to keep working at it here. Just a second. Sorry about that. Here is my discount. And let me make sure I got a 5-year semi-annual, so that makes 10 payments. Okay, so then I'm going to divide by 10. And I got 335,138. And it didn't want to take that. Okay. All right. Let's see what I keep saying. Really? Okay. Well, okay, we're doing this for the full 6 months. So it's not like because this happened on July 1st. So we have July, August, September, October, November, December. So that's not an issue. And I did this the last time, so I don't know what is happening here. Well, these two numbers have to add up to the interest payment. So we got the interest payment figured out, right? So then you're supposed to then subtract the discount from this amount, the amortization of it, right? So the amortization, and I divided by 10, and let me just put this in one more time. I got 3,351,383 divided by 10. Okay, and I rounded down, which is 335,138. So let me put this in, 335. And maybe I keyed it in wrong. Who knows? Okay, 335,138. It still doesn't like it. Okay. Well, okay. Let me try 137. Let me see if it's being cranky. Nope. Okay, round to the nearest dollar. Well, I thought I was. Okay, let me go up to 9. No. Okay. Okay, hang on a minute. Let me go see what it is that we're not catching. Because, like I said, I did this last semester and it worked out just fine. So, just seems like this is the semester for all of this to happen. But that's all right. We'll figure it out. Let me make sure that I've got all my bond price. Okay, so I got the cash in. Let me take out everything that I had in here before. And no. Okay. Let me do this on the calculator. Let me take, because sometimes Excel gives you a rounding issue. So hang on just a minute. I'm going to use my old calculator here. I'm going to take 3,351,383, right? Which is what they said is right. So we're taking that discount. We're going to divide by 10 payments because it's 5 years times 2. Okay. Let me try it one more time. 335. Probably me putting in something wrong. 3,351,383 divided by 10. We got 335,138. I just don't know why it's not doing that. Okay, well, and you all are getting that as a wrong answer when you divide it by the number of payments. Okay, so here's what I'm gonna do. Hang on to this.
Even when I get the expense, if I take my expense minus my cash,
Mhm.
it should be what I got.
Right.
And it's saying it's.
Okay, and you know what? You're right. That's what's wrong. My fault. And you know what? I've got it right here. But did I put it on the other side? No. Thank you, Haley. Like I said, I really do appreciate when people are helping and paying attention. Let's put it on the other side. Oh my gosh. So my fault. So, okay. Whew. I was about to pull my hair out. Let's put that over on the other side and see. Hey, there we go. I had it in my T accounts, but was I paying attention? No. Sorry. So now, here's why you don't solve for the interest. You wait to see what this is going to be and what this is going to be. And when we have a premium, we will put it on the other side. So let's add these up. And then now we're actually paying more interest expense than the payment that we made. You say, so whatever you do, solve for interest expense last, because this took me a long time to understand. And it's still not clicking. So we're reducing, thank you, the discount. We'll be doing this if this bond stays put for the 5 years it's expected to. Every interest payment will look just like this. So what's cool about this one is then we can just put it in this one exactly the way we have it. Okay, so if I add those together, right, now my interest expense is to add them together. So let's do it. So the interest expense, okay, and my payment, I didn't put my payment in. Let me go ahead. So my payment of interest is 1,736,000. So I'm putting that in 1,736,000. Okay, and then when you add these two credits together, you get a debit that equals both of them. So, okay, so here's where my interest, and my interest is going to go, it's an expense, so it's going to be a debit. You can tell that I have made a lot of mistakes over the years because I'm not sweating at all. So anyway, all right, good. We got it, I think. So this is actually a really good lesson because we were forced to really pay attention to how this gets calculated. So when you have a bond discount and you sell it at that, you actually get to expense, right? You get to expense more than you sent out. And why? Because we are amortizing that discount. So we're going to use this again now for the second payment of interest, which will be after a full year of this bond being around. So you just kind of look up and put in what you just put in. This is called a reoccurring entry, right? Reoccurring entry. And when you do this in accounting software, you can actually create a reoccurring entry that you don't have to rekey every time. And you just say, process, use this reoccurring entry, and whoop, it goes in. You don't have to remember all of what you did before. It just does it for you. Now you got to have documentation as to why it was calculated that way. This would be good documentation on how it was calculated, right? And so now we're gonna put in the cash going down. Put in the amortization of the discount for the second time and the interest expense again. Okay, so if you'll, like I said, if you'll kind of learn to put that information in, that will help. 1,736,000 is our payment of interest to the bondholder. Okay, so I'm putting that in. I'm putting in the credit to amortize the discount and then the interest expense for both of those credits. There we go. Okay, so the nice thing is once you, and especially if you buy bonds on the first of a year or 1st of July or whatever your business is doing for a fiscal year. Now, here's the thing. If you drew the T accounts, you will see, now it says, determine the total interest for year 1, right? Year 1, this was year 1 right here. So it's just this, okay? Year 1, because we bought these in July and we waited to pay the 6-month interest at the end of that year. So just for the year, the first year we took this bond out, I'm going to put 2,071,138 as the total interest expense. Okay. If this is year 2, right, we're going to have another one of these and it would actually be double that interest, right? So if we waited, if we still had the bond at this time, we put 1231 for year 2, and these two would be the amount. So the real interest for the whole year of this bond is 8%. Right? 8% times 1. Because we took 8% and divided it in half because we were making 2 payments. Now, will the bond proceeds? Bond proceeds is the amount that the bond brings you. How much? That is the bond price, right? The bond price was right here, the amount we received. Will the bond price always be less than the face when the contract rate is less than the market rate? Yes. That's the reason that the bond price is less than its face, is because the market is commanding a higher interest rate than our bond. The only way to sell our bond is to sell it at a discount. Now here comes something called present value. If you guys want to learn a lot about present value, come take my personal finance class. It works out pretty well. We got people doing time value of money over there that don't even know they're doing time value of money. But this is what they do when they actually calculate what that bond price is going to be. So I'm going to teach you how to do this. Okay. So we're going to compute the price. So put the price that you've got right here in the proceeds of the bond issue entry. Did you hear me, Monty? Mm-hmm. Okay. All right. Well, if you want to watch the video later, that's fine. 40,048,617. That is the bond price. Now I'm going to show you how that price is calculated. Now, I don't plan to test you on this, on the test, but I want you to have a little bit of idea of how this works. We've got 2 amounts for this bond. We've got the face and we've got those semi-annual interest payments, right? There's a way to use something called present value. Okay, present value is today's money now. Okay, today's money now. So a good way to think about present value is how much money does it cost to buy a loaf of bread? Or how much money today does it cost to buy gasoline? Whatever it is, chances are in the future it's going to cost more. So unfortunately, we've got to come down to the present value of the face and the present value of the semi-annual interest payments. Don't try to understand it necessarily, what the present value is. learn how to calculate it, and then worry about understanding. I think you'll be okay. It's kind of like that recipe we've been talking about. So you're gonna have two amounts. You're gonna have the present value of the face and the present value of the interest payments. We're gonna calculate an amount that when you add them together, you'll come up with those bond proceeds. Okay, so here's how you do it. You're gonna have the bond face times a present value factor. Okay, we've got two tables here. We've got one for one amount, and then this is for an annuity. An annuity is a payment, more than one payment, but it's the same payment over and over and over. Well, that's that interest payment that we're making, right? So we're gonna take the face first, okay? And we're gonna go look at, now watch it, when we figure out what factor to use, we're gonna use the market rate of interest. That's the hardest thing about this. My market rate is 10%. Yours is 12, yours is 14. So then we're gonna divide it by the number of payments in a year, right? So I'm sorry, yeah. So we're gonna use the market rate and divide by 2. And then we're gonna look on this table, okay? So here's what I've got. Here's what I've got. My bond face, all right, and I've got it calculated here, but now I've got to go find this factor. This is a factor from the table. So notice my factor for the face value is point something, something, something. So let's go find that. Let's open up this table. Okay, this table. So here we are. And my market rate of interest is 10. So 10 divided by 2, I'm going to actually look in the column under 5%. You're going to look under 6%, Haley. And Monty, you're going to look under 7% of this table. Are you using the table?
Yes.
Okay. Then we're going to figure out how many payments. I've got 10 payments. Okay, 10 payments. So you have 14 payments and you have 12 payments. So you go down under which column you need and you find a number. So mine is 0.61. Let me go back. Mine is 0.61391. Okay, 0.61391. Well, let me put this down here. Over here. Here we go. Mine is 0.61391. Make sure you get all 5 of the digits. All 5, because it's going to matter. So then we're going to take our 40, we're going to take our face times that factor, okay? And we're going to get a number, okay? We're going to get a number. So that face times the factor. So when I do the face of mine, let me get back to where I was here. Okay, so when I do my face of 43,400,000 times the factor I found, and I'm going to put at 5% for 10 payments. You got to find it, and you got to make sure you're using the right table. This table says a value of $1. Value of $1. So that's the one we're going to be using. Okay, the present value factor from the table. The table is present value of $1. Okay, the other one will say present value of an annuity. So when I take 43,400,000, my present value, okay, and I'm going to put this in my problem now. Let's put it in. So 26,643,694. Okay, that should be the present value of the face. Well, you have 2 choices now. You can either just plug for this number, because this plus this should be this. Or you can, I'm going to go ahead and take you the long way of finding this. Okay, you can go ahead and do the short way, but I'll prove it to you. So we do the same thing again, but we take the interest payment that we're making. Okay, and this is gonna be using the other table, but we use the same factors. We use the 5% with 10 payments. So I now need a present value factor from the other table. This table is called the present value of an annuity. Annuity is a payment of more than one amount. It's the same amount over and over. Okay, so I'm going to take my payment of 1,736,000 that I'm paying in every 6 months. I'm going to look at this table. Okay, this is a different table, but we still use those same factors of 5% at 10 payments. So I'm going to look for that 5%, 10 payments. Okay. All right. And I am going to put that factor in. So 5%, 10 payments is 7.72173. Just got to put it in. 7.72173. And now I'm going to take that times my interest payment. Okay. And I get 13,404,923. Now I'm going to put this in Cengage. Okay. 13,404,923. And if you add down, and you could do this with a calculator in case you miss it. So if I add down both of these numbers, 26,643,694 plus the present value of the semi-annual interest payments, which is 13,404,923. Together, they add up to the bond price, which is the proceeds of a discounted bond, which is 40,048,617. Okay. So you say, well, it's a lot easier just to plug for that number. Well, that's fine. I don't mind if you do. If you learn that there's two pieces to a bond price, that will help. Got to find the present value of the face, present value of the annuity payments or the interest payments, and add those two numbers together. Okay. So no, I'm not going to test you with calculating this, or at least I hadn't planned to. But I would like you to understand what a bond price is made of. Okay. It's made of two numbers, present value of the face and the present value of the annuity, which is the interest payments. Okay. So I know we just got through one problem, but I had troubles because I was messing up. That's not going to happen. All right, let's move on to number 2 now. Okay, number 2. We're going to try to get this knocked out. And now that we've gone over the characteristics of a bond, I would suggest you write down the characteristics of your next bond. Okay. The face of this bond for me, okay, I'm putting in 88,200,000. Okay. I've got a 10-year bond that has a coupon or contract rate. Contract rate and coupon rate is the same. Mine is 13%. Okay, mine is 13%. So now let me keep going. I'm going to keep calculating all the stuff I need to know. It is paying semi-annually, December 31st and June 30th. So I'm going to take semi-annual. And this is a 10-year bond, so I'm going to have 20 payments. Okay, so you might kind of calculate how many interest payments will be made on this bond. Now let's calculate. Let's calculate an interest payment. So you're going to take your bond price, your bond face, 88,200,000 times, okay, the interest rate, mine is 0.13 times 1 divided by 2. Okay, same formula. Okay, so now I'm gonna put this in and see what my interest payment will be. And remember, this time I'm making 20 payments of interest, but I have an interest payment that's higher than what's in the market. Yep, it's higher, 88,200,000 times 0.13 times a half. So my goodness, my interest payment is 5,733,000. Okay. My bond price, go find it. If you're selling, let's think about it. Our bond, 13% interest. What's going on in the market? 11. Woo! So we have a real attractive bond. We've got just the opposite problem. We're going to have a premium, right? So one more time, my bond is paying 13%. The rest of the market's paying 11%. I'm going to have a lot of investors interested in my bond. So we get to command a premium, right? Okay, the premium. So here's how we're going to calculate our first journal entry. Put down how much cash came in for your bond. Okay, mine is 98 million. I'm going to put this right up here. My bond price is 98 million. I probably do overkill on this, taking notes of the bond characteristics, but this was a very difficult subject for me at one time. And I really have to go be very meticulous, right? I have to be very meticulous when I put my stuff in because I really want to try to get it right. Okay, so one more time, my bond price is 98,740,315. What is my bond face? 88 million. Wow, I'm getting about 10 million more than what my face is, right? Fact of the matter is, I need to know what my premium is. What is the difference between the bond price and the face on the bond? Okay, so you'll want to know what that is. Okay, I got $10,540,315 more for my bond. Okay, my bond. Notice I have a premium on bonds payable account now instead of the discount. Okay, so we're going to figure out how this is going to be put in to issue the bond. Okay, we're going to issue the bond and we'll do pretty much like what we did for the discount. So let me bring this over to the side. It's funny because I think this is going to be so simple, and then I mess things up by not paying attention. But I always learn a lot more from my mistakes than I do anything else. So let me bring this back over to my screen. Here we go. I always forget my split screen here. All right. So one more time. I'm going to put the face in the bond. So I'm going to put the face. Mine is 88,200,000. This happens on July 1st, just like we did with the bond, the discounted bond. Okay. So, and then the proceeds are going to be your bond price. Okay. So you're going to put that in, and then the difference will go in the premium on bonds payable as a credit. So the amount that you need to put in there, okay, is the cash price minus the bond payable. So I've got a premium here of 10,540,315. Yes, that's the difference that I found up here. So I'm double checking on that. So one more time, my cash is the receiving the cash. Just a second. Okay, so it is 98 million 740,315. Okay. And I put this in the wrong spot. let me put that at the top. This should be your bond payable. Okay, bond payable should be the credit. All right, so one more time, 98,740,315. The face goes in the bond payable, 88,200,000. Okay, and then the difference is the premium. The premium that was paid on top of the face. Okay, mine is 10,540,315. Okay, so give it a try, see if it works. Okay. And now we're going to figure out an interest payment. Now we've already calculated the interest payment if you followed along with me. Okay, if you followed along, we've already calculated that interest payment. Okay, so I'm going to take the bond price. I'm putting my premium amount back in that I accidentally deleted. So just a second here. Get over here. There it is. Good. All right. Now we're going to do amortization of the premium, very similarly to the way we amortized the discount, but just the opposite. So we're going to take the amount of the premium and divide by how many payments of interest that you're going to have. Mine is 20. Okay, 20 payments of interest. And every time we make a payment, we're going to debit this account. Yep. So I'm going to calculate how much the amortizing the premium will be divided by 20. So every time I do an interest payment, I'm going to make this premium go down by that amount. I'm going to make cash go down by the amount we calculated for interest payment. Okay, so down goes cash to make this interest payment. And it's the face times the contract rate times 1/2. So 5,733,000. And I'm going to make the premium go down and hopefully get it right this time. To make a premium go down, you debit it. $527,016. Now you plug for your interest expense, which we need another debit added to the amount we are amortizing the premium on the bonds payable. So you would calculate this by taking the cash. Okay, so here comes interest expense. Just a moment.
Incoming call from 539-233-0481 for
I
Ron.
don't want to talk to you right now. Okay, let's calculate this. This interest is not adding to credits. It's taking the proceeds that you got from cash and subtracting the amount you are amortizing your premium. And hopefully this will do a lot better than the last one. All right, so now I'm going to put 5,205,984, and those two numbers should add up to the interest payment that we're making. Okay, let me see if I'm right. Whew. Okay, the good news is the second payment is just like the first. So you just follow the leader there and put that amount in. Okay, so it's going to happen. All right. And then the cash goes down for the amount of the interest payment that you calculated to begin with. Okay, there we have it. We've just made our two interest payments. So I'm going to do that again. I'm just going to put it in here again in the T accounts. We made two interest payments. Can you imagine making an interest payment of $5,733,000 a year? Whew. I don't think so. Anyway, oh, these numbers drive me crazy. It's like, could you just make them a little bit smaller? But I guess they're trying to represent the corporate world. Anyway, so then the third question is determine the interest expense for that first year. Well, because we sold these bonds in the middle of the year, we only have half of the interest we would have for a given year. And it's whatever you found your interest expense to be. That's that plug number for making the payment, right? So I'm going to put 5,200,000, yeah, 5,205,984. Okay. So that should be that first interest. And that's why I put it in a T account so you could see it a little better. Okay. Now you just simply, it says, will the bond proceeds always be greater than the face when the contract rate, which mine is 13%, is greater than the market rate, which is 11%? And the answer is yes, because that bond is more attractive. I'd much rather earn 13% on my money than just 11%. It's extra, right? So the answer is yes. And then just like we did the last bond price, fill in the bond price again down here where it says proceeds of the bond. Okay, proceeds. That is the amount of the bond price. Okay, so once again, mine is 98,707,40315. Okay, so put that in and check it to make sure you've keyed it in right. And now we're going to do exactly what we did the last time. We're going to find a present value. Come on. A present value for, and I've got my spreadsheet. I've got my spreadsheet here ready to go. Okay, let me take out my, okay, because I've got to look for a present value factor. And be careful. I've got to use the market rate of interest. My market rate is 11%. I got to take half of that, right? Which 11 divided by 2 is 5.5. Yep, and that's one of the factors I look for, 5.5. My payments are 10 years times 2. So I'm going to be looking at 5.5. So I'm taking 11% divided by 2, which is 5.5 and 20 payments. So you'll need 5.5 and 20 payments to look up the right factor. Okay, we're going to have to look up a factor. 5.5% for 20 payments. Okay, so let's use that first. Oh, they didn't give us this one, did they? Ooh-wee. Oh, no, there it is. I was going to say, what? Okay, so here we go. You say, how do I know if I'm on the right table? It takes practice. Okay, when you're finding the present value of the face, that face is one amount. Okay, and it goes on present value of $1. Present value of $1. And if you've got it done and need to go, that's okay. Same with you guys on Zoom. Stick around. I'm going to go ahead and do the video for 12, and then I'll have it out there shortly. Okay? So if you need to be on your way, I'm sorry this took so long, mainly my fault, but there's a lot of pieces to this. And you got to know what those pieces are. But once you plug it in to the template, it's not too bad. Okay, my factor is 5.5% for 20. So I'm looking at 0.34273. 0.34273. And I got to take that times the face. Okay. So there's the present value of the face amount that has to be added to, and then my interest payment. And I need a factor again. But once you've found the 5.5% and the 20 payments, that's the hardest part, to know what table to look at. And so now that second table needs to be the present value of an annuity. Okay, instead of present value of $1, present value of annuity. So that's how you know the difference. And then once again, at 5.5 for 20, and it's 11 point, okay, my factor from my table is 11.95038. And I'm going to take that times my interest payment, and there you have it. I know. So this is the present value of the face of that bond. There's the present value of all those annuity payments. And when you add it together, that's how you get the bond price. Okay, so I'm going to put this in. And like I said, you guys are welcome to be on your way if you need to. Same with you guys on Zoom. And stay tuned. I'm going to do this other one, like right after this one. So, and then I'll post this too. Okay, so there you have it. Okay, there you have it. Probably more than you'd ever want to know about a bond. But it took me a long time I have set up a pattern of putting all that information in, figuring that interest payment, finding out how many payments, make sure I identify the contract rate versus the market rate. So see, the thing is, if the contract rate is the same as the market, it sells at its face. So you don't have a discount or a premium to mess with, which is even easier. But that very rarely happens, unless the bond is issued immediately when the interest rate change. So they're waiting to see if the Fed's gonna change interest rates in December. I don't think they're going to. I think it's gonna stay. That's my bet. That's my bet. We'll see what happens. We'll see if our president pressures them to lower it. Which is, you got to let them do their job. That's why they're supposed to be independent and not pressured. All right, guys, I'll have this other one out here, so I'll stop my share. Okay, Jackson and Chris, I see you were here. I'll put you in, and I'm also going to stop the recording, and then look for the next video for chapter 12's coursework. I'll have